25 seconds away from the opening bell this morning. Good morning. Pulling back just a touch. We're down by something like 0.1% on the S&P. On the Nasdaq, a similar move. Yesterday, really decent rally. Biggest one-day pop on the Nasdaq going back to the end of August, inspired by a weak ADP report that everyone says they don't care about. Then you get a downside surprise, and apparently everyone cares about it. There's your opening bell. Switch to the board and get to the bond market. This is what happened yesterday. Yields down aggressively. We add to that move, down another 2 or 3 basis points. 470.40 on a 10-year, after adding something like 150 basis points from the post-SVB failure lows early in spring. In the FX market, the euro trying to show some strength against the dollar, which has just been absolutely dominant over the last couple of months. 105.27 on that currency pair, up by 0.2%. And look out below on crude. All the talk about triple-digit crude by the end of the year, and here we are back down in the 80s. 82.77, down by 1.7%. Yesterday, the damage done. Severe. Big one-day sell-off, the biggest of the year so far, going back to September of last year. Apparently Cushing, the numbers look a little bit better. Gasoline demand looks a whole lot weaker, and then here we go. Big reversal. One stock to watch at the open, Clorox, the company announcing that a cyber attack that took place in August will reduce sales and profit, warning this: the impact from the attack more than offset the benefits of pricing, cost savings, and supply chain optimization. Abby has more. Hey, Abby.
Hey, John. And speaking of the worst day of the year, that is the case for Clorox right now, down more than 4%. Heading to its worst day since November of 2022. So even though there was some telegraphing of this in terms of the hack, the cyber attack happening in August, and that it could impact numbers, investors are pretty surprised that we're seeing, again, the worst sell-off for the shares of Clorox on the year. Now, as you mentioned, they have basically pre-announced to the downside. They now see net sales decreasing by 23 to 28%. They're looking for a loss of 35 to 75 cents for the quarter that ended in September. So really a pretty negative issue there, and it's a matter of operations, inventories, supply chains. That is where the supply, the hack really has weighed, that they're not able to have the proper products. And it's thought that Scattered Spider, a group of hackers that were tied to recent cyber attacks on casino companies such as MGM and Caesars, could be a piece of it. Something I'd like to point out here, John, so of course the street is somewhat skeptical on this and cautious on it. This stock on the pandemic, if you recall, everybody wanted to buy Clorox in the time of the pandemic. It rose 66% between the start of the pandemic and the pandemic peak. Well, now it is down about 50% from that pandemic peak. What goes up must come down.
Amazing. We're down about 3.9%. Let's call it 4% lower. We've talked about that cyber attack threat for such a long time. It showed up in a pretty unexpected place, I have to say. Clorox, a whole lot lower this morning. For the broader market, about 2 or 3 minutes into the session, we're down here by not even 0.1% on the S&P. Similar move on the Nasdaq as well. Want to stick with consumer discretionary. Constellation Brands raising its annual profit target after topping sales expectations. The CFO saying this: the record top line and operating income performance of our beer business has enabled us to keep delivering on our priorities. Simone Foxman on top of this story. Hey, Simone.
Yeah, John, beer very strong, but we're looking at shares actually down now early in the session, down 2.3%. Even though the company beat comparable earnings per share guidance for the full year, now sees EPS 370 versus 317 year on year. The estimate was 339. Full year guidance beating the average analyst estimate. Analysts were looking for 1167, but now the company is saying for fiscal year 2024, it expects profit between 12 and 12.20 per share. Beer income really leading the charge here. Beer sales were up 12% year on year. Most analysts had anticipated a rise of about 10%. But wine and spirits, incredibly weak and much weaker than had been anticipated. Operating income in that segment down 19% year on year. I think the question mark here is really about the durability of these sales, because a lot of the reason people are buying Modelo beer, that's Constellation Brands beer, is because of missteps by a competitor, by AB InBev, around its Bud Light advertising campaign that included Dylan Mulvaney, a transgender woman. So maybe the question is about durability. Maybe the question is about just the size of those beer sales, considering some analysts likely thought the beer sales sales would be higher, but now we're seeing shares down over 2% this morning.
Down over 2% to 243. Simone, thank you. Let's turn to the autos. Rivian announcing plans to issue $1.5 billion in convertible debt and reporting preliminary Q3 revenue. Isabel Lee has the numbers. Hey, Isabel.
Hey, John. So these green senior convertible notes due in 2030 are private offerings to qualified institutional buyers. And Rivian also is extending an option for buyers to purchase an additional $225 million. So the bond issuance, of course, could dilute the current shareholders' interest, but Bloomberg Intelligence is saying that the timing makes sense. But this, of course, comes after Rivian has disappointed investors earlier this week when it maintained its full-year guidance of 52,000 battery EV vehicles this year. So Rivian also said it expects revenue in a range of $1.29 billion to $1.33 billion. So that's roughly in line with estimates. So Rivian, like others, has really struggled with supply chain issues as it plays catch-up with Tesla. The company went public in November 2021 and has fallen around 80% since then. But year to date, it's up 30%. For now, though, it's really plunging by around 13%, John. But we'll know more when the company releases its earnings on November 7th.
Looking forward to that. The stock is getting absolutely hammered between now and then based on this move. Isabel, thank you. Let's turn to tech. Amazon and Microsoft Cloud Services facing an investigation by the UK's antitrust watchdog over concerns of market power abuse. The Competition and Markets Authority CEO saying this: many businesses now completely rely on cloud services, making effective competition in this market essential. Katie joins us with more. Hey, Katie.
Hey, John. Yeah, the CMA launching an investigation into the UK's supply of public cloud infrastructure services. Now, this follows a years-long study from telecommunications regulator Ofcom, which found evidence that major players, including Amazon, including Microsoft, have made it difficult for customers to use multiple suppliers or actually switch suppliers. And as CMA CEO Sarah Cardell said, both Microsoft and Amazon, they provide increasingly essential remote storage and computing. And currently, both of those companies make up between 70 to 80% of the UK cloud market. And now, if significant issues are found by the CMA, they do have the power to impose structural remedies that could include selling off part of their businesses to really improve competition here. But the CMA's market investigations, they typically last around 18 months, John. So we're going to have to wait until about April 2025 or so to actually see that report.
2025 feels like a long way away. Katie, thank you for the update there. Amazon down by 0.8%, Microsoft up by something like 0.4%. The broader equity market about 6 or 7 minutes into the session is almost totally unchanged on the S&P 500. On the Nasdaq 100, it is totally unchanged. Year to date, if you want those figures on the S&P 500, we're still positive by something like 11% on the S&P, and on the Nasdaq up by more than 20. Keeping an eye on the bond market, the losses there absolutely dramatic. On longer dated treasuries, they're approaching 46% since peaking in March of 2020. That's just shy of the 49% decline in US stocks during the dot-com bubble. Joining us now to discuss, PIMCO's Mark Kiesel. Mark, it's been too long. It's good to catch up, sir. Can we talk about those monster unrealized losses, for some people at least, in the treasury market? Mark, have we seen the pain from all of that earlier this spring? Have we left that behind?
Jonathan, we think most of the sell-off is overdone. If you look at what's caused treasuries to back up, it's been a strong economy, it's been high inflation, and also chronic deficits, which has led to a supply and demand imbalance in the treasury market. But we really do see three catalysts for lower yields over the next 1 to 2 years. First, nominal growth has peaked, it's slowing. Secondly, inflation has peaked, it's coming down, the Fed is credible. And third, there are rising recession risks. This monetary policy is now restrictive. Importantly, these rates right now, both nominal and real, we haven't seen these, Jonathan, in 16 years. So actually, we think bonds are very attractive here. There's been a very great time right now to move out of equities into bonds. We think you can get basically near equity returns in the bond market. We have not been able to say that in 16 years. So we're quite positive on bonds right now.
Mark, when you say in the bond market, credit specifically, treasuries, all of the above, the whole universe?
We specifically like shorter maturity, high quality bonds right now. You don't have to extend out the yield curve. You can get basically 6 to 6.5% by focusing on very, very short duration, high quality corporate bonds. Importantly, companies are throwing off significant free cash flow. They're delevering their balance sheets. The opposite is happening at the government, where governments are taking on more debt. Debt to GDP is rising. That's not happening in the corporate bond market. Fundamentals are improving. Companies are using all this excess cash flow to delever, pay down debt. And importantly, at these higher yield levels, you're going to get less supply and more demand. That's not what's happening in the government market, the Treasury market, where you're getting more supply. So you've got more favorable fundamentals in corporate bonds, more favorable technicals, and valuations we haven't seen, Jonathan, in 16 years. This is the time to buy high quality, short duration corporate bonds.
Mark, I've got to say, you sound really bullish. When was the last time you were this bullish?
Jonathan, we have not been this bullish in a long time. It literally was back when we had the ring the bell moment, over 3.5 years ago, March 17th of 2020. So we are very bullish on short maturity, high quality investment grade bonds right now.
So when I look at spreads, they still look pretty tight. High yield spreads are something like 420, went through 400 in the last few weeks or so. Mark, some people might say that's not wide enough. There's weakness to come next year in the economy. Beyond that, we've got that maturity wall in high yield that's going to kick in as well. There's a lot of companies that need to supply, come to market, raise some money. What's the argument against that, Mark?
Well, Jonathan, the argument against that is that we've seen unprecedented growth in the economy, and companies have termed out their balance sheets. There's very little short-term debt coming due. If you look at the last year, there were 14 times more upgrades than downgrades. So companies, per my earlier comment, companies' fundamentals have been significantly improving. This is the opposite of the United States government, where fundamentals continue to deteriorate. So while companies are paying down debt and delevering, the government is relevering. And so basically the credit fundamentals are much stronger for most of these companies than for the government itself in terms of trajectory.
Let's talk about favorite sectors right now, Mark. What are they for you?
So, Jonathan, we've talked about this over the last year, particularly when you visited us in Newport Beach. Fun. We love fun. Fun is basically what people haven't been doing for 4 years. They're getting on planes. They're staying in those hotels. They're going to Vegas. They're spending money on concerts. This is where PIMCO's been invested for the last 2 to 3 years. And these companies are generating so much excess cash flow, they're able to delever that balance sheet significantly. They're not rewarding shareholders. They're actually delevering. So they're doing, again, the opposite of what the government is doing. This is exactly, as a bondholder, what we want to see. So we love fun, and fun is where the opportunity is.
So airlines, hotels, cruise lines, all of the above?
All the above. And in addition, if you look at some of the highest quality American banks today, these companies literally generate 8 to 14 billion of profit a quarter, and you're getting paid now 6 to 6.25 for 5-year maturity bonds. We have not seen this, Jonathan, in 16 years. This is really a huge opportunity.
So, Mark, I want to wrap it up. You've said this a few times in this conversation. They're deleveraging. The US government is not. The credit call is super bullish. Mark, what is the Treasury call? Are there deep-seated concerns about where this is heading?
So, Jonathan, we think the Fed is close to being done here. The Fed looks a year forward and sees unemployment rate at 4.1. We see unemployment rate going much higher to 4.5 to 5 over the next year. So we do think this slowdown is coming with the economy, and we think you're not going to be able to buy these yields 1 year from now. So now is the time to start extending that maturity wall. Bonds very attractive today.
Mark Kiesel, thanks for the update. Mark Kiesel of PIMCO there, super bullish on this bond market. Haven't heard Mark like that for a long, long time. Mark, thank you. The broader equity market just a little bit lower, down 0.25% on the S&P. On the Nasdaq, we're down about 1/3 of 1%. Coming up, the race to replace Speaker McCarthy heating up.
It's not just about the person. Both of these folks are honorable men. It's about the plan they have to reduce spending.
Congressman Matt Gaetz back in the latest bids from Congressman Jordan Scalise. The latest from Capitol Hill. Up next.
it's not just about the person. Both of these folks are honorable men. It's about the plan they have to reduce spending. I'm for both of them right now. I'm eager to hear their plans and their vision. But if the House of Representatives goes from the stewardship of Kevin McCarthy to either the stewardship of Jim Jordan or Steve Scalise, that's going to come to the delight of many conservatives.
The battle for House speakership heating up. Second-ranking Republican leader Steve Scalise officially joining the race, making him a top contender. Conservative Jim Jordan also announcing his run. McCarthy's successor faced with the task of avoiding a mid-November government shutdown and patching up intra-party conflict. This as Fitch Ratings downplays the impact of a potential shutdown, telling Bloomberg, quote, "We don't think that the political brinksmanship or even a government shutdown in the coming weeks would affect America's stable sovereign rating." For more, let's get to Bloomberg's Anne-Marie. AMH, what's the latest?
Well, John, as you've outlined there, there's really two top contenders right now, and it's House Majority Leader on the Republican side. That is Steve Scalise. He's number two. He's talked about it in a letter that he's been the individual that's been able to really hear out all the diverse views of that caucus. One potential issue with him, Jonathan, is that in August, he announced that he was undergoing treatment for blood cancer, but he still says he feels good and he wants this position. Then you have Jim Jordan. This is a staunch ally of former President Donald Trump. This is someone who also was very loyal to Speaker Kevin McCarthy. Before that motion to vacate, he told Joe and I on Balance of Power he does not want to be Speaker and he supports Kevin McCarthy. With Kevin McCarthy gone, he thinks potentially he can be that person that is able to bring this party together. The issue is, can he garner support for some of these centrist districts where, yes, their congressman or woman is a Republican, but they voted for President Biden. The biggest issue, Jonathan, it's just not obvious at this moment, is who can get to 218.
So true. I think it's interesting right now that, Anne-Marie, you've got Republicans fighting with each other as Democrats start to sound more like Republicans. I'm talking about border security at the southern border. AMH, I think this is such big news for this country. What a change of course for this president.
Absolutely. This president said he wouldn't add an inch to the border when he was campaigning. This is the border that Trump continually talked about, how he wanted to build a wall. And now they're going to be adding about 20 miles to this border. There was a notice published from the Department of Homeland Security about this. They're having to forego some of these laws to get this border enacted. But, Jonathan, this isn't just pressure from the Republican Party that is likely putting a lot of making the Biden administration want to move on this. It is pressure from his own party. Governor Pritzker sent a letter to Biden yesterday. You constantly hear from Eric Adams, the mayor of New York. These Democratic-led cities, these Democratic-led states are saying they need more help and aid from the federal government because they are also dealing with a migrant crisis.
This is a really big change. Anne-Marie, I'm looking forward to the program a little bit later. Balance of Power with AMH and Joe Matthew together with Katie down some of these big issues. Let's turn to strikes. UAW negotiations with Detroit's Big Three reportedly progressing. The union president, Shawn Fain, set to give an update tomorrow. This as Kaiser walkouts enter a second day in the largest U.S. healthcare strike in recent history. A union spokesperson said this: frontline healthcare workers are awaiting a meaningful response from the company. Key priorities including safe staffing, outsourcing protections for incumbent healthcare workers, and fair wages to reduce turnover. Katie has the latest. Hey, Kaylee.
Yeah, John, this strike is 3 days for Kaiser Permanente workers, or a coalition of unions representing them. That in total represents about 40% of the total workforce. This could affect healthcare services for nearly 13 million people, non-essential services like routine doctor's visits, for example. What the union wants is some of what was just laid out there. In addition to wages, this is about combating staff shortages, providing protections for these workers. What's interesting, though, about this strike, John, is that it's temporary in nature. Because of healthcare union federal restrictions, they have to return to work, even if there is no deal by October 7th. So this is going to be short-lived. That's not to say that they couldn't strike more later on, but for the time being, this is only going to last for a 3-day period. That, of course, is not the case when it comes to the UAW strike, which is about 3 weeks in length now with no clear end in sight. And of course, we will expect another Friday update from Shawn Fain in regard to progress in talks with the Big Three, potentially another escalation of the strike. Of course, we have seen Stellantis and Ford each spared escalation at least one time. Ford, of course, earlier this week made a sweetened offer to the UAW, more than 20% wage increases, bigger contributions to the 401k and the like. Though Ford also has laid off another couple hundred workers, bringing the total layoffs related to this strike to about 1,330. GM, meanwhile, has not been spared any escalation thus far. And GM said yesterday that the total cost of the strike for them at this point is about $200 million, which is why they have secured a $6 billion line of credit to build up liquidity, which is kind of a sign that this company, GM at least, is gearing up potentially for a prolonged work stoppage. We'll wait and see what real tangible progress Sean Fain details tomorrow.
Much longer already and deeper than many of them were hoping for. Katie, thank you for the update. We'll get an update from UAW tomorrow. On the same day, we'll get an update on the labour market in America. The payrolls report just around the corner. The estimate at the moment, 170,000. The previous number, 187. Let's get you an update on this equity market right now. We are about 22 minutes into the session on the equity market, pulling back by about 1/3 on the S&P, down by about 0.5 on the NASDAQ with the sector price action. Here's Abby.
The sector composition, John, looks a lot more bearish than that relatively modest decline. 10 of the 11 S&P 500 sectors are lower, led by energy, communication services, discretionary utilities, kind of flipping around down there, down more than 0.5%. The one sector higher is healthcare, up about 0.5%. We've been talking about energy, and I really love the fact that you're pointing out that yesterday's decline for oil was the biggest in September of last year. If we take a look at the last 5 days for oil and two of the different energy sectors, we're going to see a bit of red on the screen here. There's New York crude down 9.4% in just 1 week. The service equipment sector down 10.3%, and there's the energy sector down 7.83%. This, of course, is the dollar is rising, and there were some stronger inventories for oil yesterday, John.
What a difficult week it's been for everything associated with energy. Abby, thanks for that. Coming up, your trading diary, looking ahead to all the events to get you to the weekend and out the other side. From New York, this is Bloomberg.
That all day yesterday.
25 minutes into the session, pulling back just a touch here on the S&P by 0.2%. As the price action, here's your trading diary. The events you need to look for through the next 24 hours or so. More Fed speak coming through the day. Kashkari, Barkin, Bar, plus don't miss Bramo's interview. Conversation with San Francisco Fed President Mary Daly at noon Eastern Time. The prosecution continues its case in the Sam Bankman-Fried fraud trial. And on Friday, tomorrow morning, the main event, the payrolls report just around the corner. You're familiar with the estimates so far. Here they are again. 170,000 is the number we're looking for. Stacked program tomorrow, including Mohammed Al-Arian and Mike Collins, regular guests of this program. We'll catch up with Victoria Fernandez as well, and the Labour Secretary, Julie Su from New York City. This was the countdown to the open. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, October 5th. Here are the top market stories we're following for you at this hour. The cure for high yield. So Barclays says the only thing that stops the bond sell-off is a stock crash. We're going to weigh some of those options. Could it be oil? So prices crater 6% in about 2 days, falls below the 50-day moving average. We'll check that out. Could it be jobs? Claims tick up slightly. We're seeing some buying coming to the front end of the bond market. We're going to see if Jobs Friday now has the right medicine for the bond market. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. I appreciate that the front end yields are coming down a little bit, but we are still pretty sticky with the volatility that we've seen in the bond market over the last few weeks.
Absolutely. Maybe a little pause, but we don't know where we go from here, I think is the key question. I think to try and kind of figure out what happens next, Alex, we need to understand why we've seen what we've seen. So why are yields higher? Is it because of inflation? I think most people have discounted that. Is it because there are more sellers than buyers? Maybe not more sellers than buyers. Maybe there's just more supply. Yeah. Maybe that's the government question, that deficit question. Is it because of the fact that foreign buyers aren't taking up as much? You can go on and on and on. I keep asking this question, why are yields going higher? And nobody has a clear answer. So in order to maybe figure out what brings them lower, maybe we need to figure out what's taking them higher.
Yeah, you know, didn't you make fun of my question the day last week when I asked about term premium? You were in Lisbon.
Yep.
I think you made fun of me, but yet I feel like now it's really important.
Yeah, maybe it's just the R-star setting higher is another factor as well. I remember you getting far into the weeds. This is what happens when I leave you alone. You get far into the weeds, things like crack spreads come up, and it goes downhill pretty fast from there. Anyway, it's a good job I'm here today, so we'll try and avoid some of that happening. But our question of the day is a fairly straightforward one. What brings bond yields back down? To try and understand that, what is bringing bond yields as high as they are right now? Maybe that's the question we should be asking, but maybe we've already asked that one. So what brings bond yields back down? Is it a stock market crash? Mike McKee, Ira Jersey, join us now to discuss. Ira, what brings yields back down?
Yeah, I think it has to be, I agree that maybe it's the stock market, but why does the stock market go down, right? You have to ask yourself that question too. And I think it has to be that the economy is then expected to be slower than the market's thinking right now. So what drove this, I think, higher, Guy, is mostly because of better economic data and people pricing out the risk of a recession in the near term. And once if that comes back into play, if we do start to see significantly slower data, then bond yields are going to rally back down probably to the range where they were, call it 4%, 4.25% type area, at least for a little while. But we have to see that turn pretty definitively, I think, at this point.
Okay, so we got stock crash from Barclays, possible recession, slowdown from IRA. Mike, what say you?
I'm going to go with C, or behind door number 3, the slowdown in the economy, because I think Ira's right. That seems to be what is driving a lot of this, although there is perhaps a little bit of concern about how much debt the United States is taking on and who's going to buy it all. All of it kind of folds together. But this is an interesting situation because a lot of people are saying this could lead to a recession, but it's not the kind of thing that we've seen in the past. In the past, you've had an inverted yield curve that then steepens and everybody says, oh, we're going into recession. But in the past, that's been because the short end has fallen as the Fed cuts rates. Right now, it's the long end that's rising. So does that mean recession? I don't know. I'm going to defer to Mr. Jersey on that one.
Well, if you're asking me, Mike, I think that the steeper yield curve and the bear steepening in the yield curve, a lot of it is technical. So some of it is on supply, but not really. When you look at the demand at auctions, you'd expect that demand to be pretty weak and for the auctions to be problematic if this was really a supply issue. It's not, at least not yet. So I think that a lot of it is just people who were positioned long because they thought the Fed was going to pause, they thought the economy was going to roll over. And they got caught in bad positions, so they had to sell. And if you're going to sell, you're going to sell the long end of the curve because that's what was the richest.
Mike, you could also argue that the Fed bears some responsibility for what we're seeing here. Certainly post the September meeting, we have seen this move accelerating. And I keep now asking the question whether or not the Fed is comfortable with the move that it's seeing in the bond market. Is this an orderly bond market? If it's not an orderly bond market, should the Fed be worried about this? At the moment, you've got Goolsbee saying he's puzzled. You've got various other commentators out on this. But the Fed doesn't seem to be pushing back. And then you can take on the argument that maybe the Fed's comfortable with what it's seeing. And then you have to worry about the idea that maybe the Fed is kind of subbing out monetary policy to the bond market. It all gets very convoluted very quickly.
It does, but why would the Fed at this point want to push against the market? The market is doing what the Fed wants. The market is basically adapting to what the Fed has been saying for a year now, that they're going to leave rates higher for longer. And as Ira noted, they're just sort of repricing out the longs there. The question for the Fed is, does it get disorderly? And at this point, it isn't disorderly, and we have seen a little bit of a pullback in recent days. I'm not sure Ira would have a much better idea of whether we're going to see rates push higher from here. If not, if we're just talking about elevated rates, then the economy seems to be able to handle what we're seeing right now. So the Fed is not going to have a lot of incentive to do anything.
Hey, Ira, Mike just keeps asking you a question, so I'm just going to piggyback on that.
Yeah, I'm doing your job here.
Okay, fine. I'll go. So Ira, but pair that with, in terms of how much higher yields can go, with the positioning point. Because if it is positioning, I'm wondering how much positioning shift are we going to have to see?
Well, yeah, that's a little bit unclear. You know, we did a little bit of work, and it doesn't seem like a lot of the longs, the people who own the long end of the Treasury market, have completely capitulated yet. So there is the risk that on good economic news, like tomorrow morning at the non-farm payrolls, we get a better than expected non-farm payrolls numbers. Wage data is a little bit better. Then, you know, I do think that we'll probably see meaningfully higher and probably a little bit of bear steepening in terms of yields. Maybe 5% might be a decent number. I think you'll have some people who will say, you know, 5% might be a reasonable place to buy. You know, interestingly, I was thinking about what Mike McKee just said. You know, so this used to be called the conundrum, right, where the Fed would raise rates, but you'd have long-term interest rates go down, and you'd see this inverted yield curve. And Alan Greenspan called it a conundrum. So I think the fact that we've had a little bit of an unwind of how massively inverted the curve was is probably a good thing from the Fed's perspective, because they can say, look, financial conditions are tighter now than they were 2 months ago when interest rates were 50 basis points lower on the long end.
Alex, they don't need us. They can just carry on the conversation without us. So I think we should just talk to ourselves as well. You and me. We don't need those guys, Mike, Ira.
We kind of do that anyway, but that's fine.
Mike, have you spoken to anybody, and we'll get their opinion on this as well. I am concerned that I'm speaking to a lot of people at the moment who don't seem, Alex, to have a good idea of what is happening here. Now, the four of us, we can all come up with lots of different opinions, but why are we seeing what we're seeing doesn't seem to have been nailed down. So to come back to the question, what brings yields back down again? Is it something that we're not thinking about? We've got all these different opinions out there. We've got all these different ideas. Nobody seems to have a clearly defined answer. I'm wondering if, just to come back to this issue of orderly markets, how close to a disorderly market do you think we are if nobody knows what's happening?
Which one of us are you
Mike,
asking?
He's going to Mike.
That was to you, Alex. Alex Steele.
No,
this is me talking to you.
Oh. Okay.
No, I
don't
said
think
you.
He's being clear. Okay, disorderly market. I have no idea. Mike, what do you think?
There you go. At this point, I think Guy's right. There are a lot of different explanations and threads that people are pulling on to try to figure out what's going on. But this is a situation, I think, where you look at Occam's razor, and Ira's right. The simplest explanation is probably the best, that people are repositioning now for a different kind of economy, at least one that the Fed did not foresee and did not forecast the strength in the economy. But for the Fed, that's okay. The question I get back to, and we'll have to see, and this we may not see a lot of movement for a while, is can the economy withstand it? If it does, if it slows but doesn't crash, that's what the Fed wants. So they're not going to be making a difference. Maybe people run out of reasons to sell treasuries, but at this point, I don't see the Fed doing anything to change it.
Okay, Ira, disorderly, what does it look like?
Yeah,
Has it happened?
It's been reasonably orderly. This is not unusual for the bond market where you get moves of 30, 40, 50 basis points and then you fall into a range for a long period of time. You get used to the market not being volatile, and then something shifts where it's expectations usually for the economy that does it, and you wind up getting another 40 or 50 basis point move one way or the other and find a new range. So I don't think that this is particularly unusual. That being said, liquidity has been challenged at different points in time where liquidity seems fine, numbers come out and suddenly no one wants to trade, so you get these jumps in the market. You even saw that this morning with the jobless claims numbers, where you got a 5 basis point sell-off basically on data that was pretty close to expectations.
Yep. I go back to Canada on Tuesday, like one headline, 22-bit move. All right, guys, thanks a lot. Bloomberg's Michael McKee and Ira Jersey. That was really fun. Of Bloomberg Intelligence. Coming up, more insight into the question of the day, what brings bond yields down? We're going to talk to Bob Savage, Head of Market Strategy and Insights at BNY Mellon next. This is Bloomberg.
The dots at the September meeting had 12 of the 19 participants indicating one more hike. I'm less of that view now. I think given that, as I said, the bond market can do some of the Fed's job for it, if even some of this recent increase were to stick, I think the Fed could well be done.
As PIMCO Global Economic Advisor and former Fed Vice Chair Richard Clarida speaking to us yesterday. So let's get to the question of the day then. What does bring bond yields back down? Joining us now for his take, Bob Savage, Head of Market Strategy and Insights at BNY Mellon. Bob, what say you? What brings them down?
I think the only thing that's going to really cap the market is if we get bad economic data that justifies a shift in view that the Fed is wrong.